Hey, how's it going everyone? In today's video, we're diving into the fascinating world of liquidity. This topic might make this video a little longer than usual, but trust me, it's worth it. The best way to understand liquidity is through a bunch of examples. So, let's jump right in. Liquidity, in simple terms, is where people's stops are located on a chart. You'll find it at the most obvious highs and lows. For instance, if we examine this chart, we can easily identify the highs and lows. Above the highs, you'll find buy-side liquidity, where traders who shorted the market put their stops to buy back their positions. And below the lows, you'll find sell-side liquidity, where traders who went long place their stops to sell their positions. But don't just focus on the obvious levels. Dig deeper. Look for liquidity in other areas too. For sell-side liquidity, you can find it below an obvious low. And for buy-side liquidity, look for equal highs or lows. These levels become targets once the previous liquidity is taken. It's like a roadmap for your trading setup. When it comes to analyzing liquidity, I prefer using the 15-minute chart. It provides a clearer picture. Let's take a closer look at this range right here. You'll notice the obvious liquidity above and below the range. But remember, you don't always have to target the entire range. Look for opportunities within it. Let's say we run the stops above and below the range. Now, we zoom in and look for a setup. We identify a short-term high, run it, and observe a fair value gap. Drawing a Fibonacci retracement from the displacement range gives us an entry point at a discount. This becomes a valid setup. Equal highs and lows serve as targets for future trades. If we have sell-side liquidity up here, we can target these relative lows. It's all about recognizing patterns and opportunities. I hope this video has been helpful in understanding liquidity. If it was, please let me know in the comments below.